for business people.
The 500 rupee and 1000 rupee currency notes will no longer be legal tender from midnight onwards.
On the 8th of November 2016, the Government of India announced that 500 and 1000 rupee notes would be invalidated. Overnight, 86% of the currency in circulation was cancelled. The goal? To deal a financial blow to the black economy. A year later, was it all worth it? Watch the demonetization experiment on the 8th of November with Ira Duggal, only on BloombergQuint.
Hello and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza, and with me is Agam Vakil. Hi, Agam.
Hi, Navneet. Let's talk about the top headlines for now. Starting off with, the markets, in terms of the market, so we are looking at Indian markets trading in narrow range with the Nifty hovering around the 10,350 mark. But pharmaceutical stocks, have bucked the trend with Cipla leading the charts for now. And investors put in as much as 16,000 crores into mutual funds in October alone, posting the 19th straight month in inflows into financial assets. And Bharti Airtel is a top Nifty loser today after more than 4% stake exchanges hands at a price lower than yesterday's closing price.
All right, let's take a look at how the markets are trading at this hour. Well, it's been a volatile session, but more or less it's been range bound so far. The Nifty, Sensex, as well as the Bank Nifty. So all these three benchmark indices seems to be off day's low. So they're trading in the positive territory after that major cuts which were seen in yesterday's trade. In fact, the Bank Nifty now is trading at day's high, very close to that mark of 25,400. It's up almost 100 points. Remember, the Bank Nifty weekly contracts expire tomorrow, so you would see a bit of volatility coming about. And the PSU banking space, which was weak owing to the weakness seen in State Bank of India, that also has recovered. So that's also a day's high. The Nifty PSU bank has seen gains there, and as you can see, 60% of the weightage in that index is because of State Bank of India, and that's also recovered. State Bank of India is now trading in the green. Well, in terms of other sectoral indices, you have a couple of pharma stocks which have seen a good rebound in terms of the kind of fall that one saw yesterday. So the Nifty Pharma Index is up almost closer to 2%. Couple of Nifty gainers are the pharma counters. Cipla as well as Sun Pharma are your top two gainers. Besides that, Tech Mahindra, Bharti, Infratel, Asian Paints are a couple of the other gainers that one is seeing on Nifty. On the losing side, Bharti Airtel is the top loser there actually. That's down 3.5%. HPCL, Yes Bank, Heavyweight, Reliance Industries have seen a bit of losses coming about. But on that note, let's also check what do we have on trend spotting today. Mid-cap IT companies seem to be performing better than their larger peers. So will this trend continue? We will speak to Urmil Shah of IDBI Capital about it. And headhunters are painting a rosy picture for themselves while the job market remains subdued. We will be speaking to the Teamlease CFO to find out why. And we also look at how Indian equities have performed over the last 1 year and which are the companies who have actually gained after Prime Minister Modi's demonetization drive and which weren't so lucky.
Well, Navneet, let's go on start off with the first trend, and I do want to address the mid-cap IT space. Now, in terms of the way the second quarter spanned out for the mid-cap IT space, if you'll notice that a lot of these counters have posted revenues which are above consensus. And not only that, in comparison to your top four IT companies which belong to the Nifty, such as Infosys or TCS or Wipro for that matter, all of them have posted your earnings which are largely in line with street expectations. And not only that, if you consider the total percentage of revenues coming from digital services for your mid-cap IT companies is substantially larger and more integrated to their business models in comparison to some of your large cap peers such as TCS, Infosys for that matter. So again, there you have it. That's the earnings and the way earnings have panned out for your mid-cap IT companies. So, the likes of Emphasis and IT Technologies, Persistent Systems, all have come with above consensus, earnings, with Hexaware also largely in place. But that said, the real question is, are mid-cap IT companies currently, better placed and more nimble and more flexible to, adapt to the changes and the changing requirements of clients? So, well, that's what we're going to be speaking about with an analyst right now. So we are in conversation with, Urmil Shah of IDBI Capital, who can perhaps take us through the different trends that we are witnessing right now. Hi, Urmil, thanks for joining us. Firstly, let's start off with the performance of mid-cap IT companies in comparison to the larger caps. What are your observations here? And if you could tell us a little more about why these trends are forming up right now.
Yeah, hi. As you rightly said that if we compare the basket, then clearly mid-cap stocks, mid-cap IT companies have either met or beaten the consensus expectation, especially the revenue growth in comparison to what the large caps have done. Now we need to understand one very structural thing that is going on, that is the shift towards the new technologies, and for this the contract sizes have been smaller in nature. And that's why, for the large companies, even though they are, very nimble and active on these deals, but because these deals are smaller in size and shorter in tenure, the sales pipeline for them has yet not built up as required for their scale. Now, this does not matter for smaller companies who can still deliver good growth with smaller deals and build up the sales pipeline accordingly. And that's what I believe, that the shift towards digital technologies right now impacting smaller deals has led to slightly slower growth for large caps in comparison to mid cap companies. Secondly, if we look at the kind of client buckets which mid-cap companies deal with, of course, given their size, it's smaller in nature. So, a quarter of good ramp up from their top, 5 or 10 or 20 clients actually impacts their growth significantly. The most recent example is L&T Technologies, which came up with its results just yesterday, wherein we saw the large clients really growing very well, and they in fact delivered a very good growth.
Urmil, the question then is, do you see these trends continuing in the coming quarters? You're saying the mid-cap IT companies are doing well because the contract size is smaller, which they are getting right now, because there's a lot of debate about how the valuations of these marquee companies for the likes of TCS, Infy have corrected from their historical highs. And well, there is a group which also says that, probably at these cheap valuations, the stock could be attractive to have in the portfolio. My question to you is, will this trend continue, and do you think it's better to bet on IT space? It would be better to bet on the mid-cap IT companies.
So on the IT space as a whole, we are having a cautious view and have been recommending to be extremely, stock or company specific since almost a year now. And more so ever for, mid-cap companies, while they benefit, at a time when the deal sizes are small, but we need to keep in mind that, more mid-cap IT companies run the risk of high client concentration. So if there is some impact on one or two of their large clients, then that would backfire to them. What I'm trying to indicate is, just in case a couple of deals from their large clients move to their competition, then their growth could be impacted. And that's why we are having a similar review in mid caps as well, that we need to be very stock and company specific. We believe that companies which are having a slightly differentiated business model for the likes of Persistent Systems, which is more into product development and focused on platforms and IP, as well as the ER&D space for companies like Cyient and Tata Elxsi who are doing well. So if I had to pick the top three picks among the mid caps, then these are the three companies which we believe will continue to do well, not just for the second half of FY18 but as well as FY19. To answer to your second question as regards the valuation, yes, I would say that the valuation of large cap companies is at attractive level, but that is for a reason that both the revenue growth and the earnings growth, even after factoring the impact of share buyback, would be at best high single digits, or for some companies like HCL Tech being in low double digits. So while the valuation is on their side, still we recommend being very stock specific.
All right, Urme, so you know what, I'm going to flip the conversation to a certain extent, and I'm going to talk about the larger IT companies, because of the fact that a very, very large chunk of their revenue still comes from legacy businesses. Your traditional businesses which require just your basic software and maintenance. Now, do you think that it would be harder for them, considering the fact that such a large chunk of revenues comes from that, would it be harder for them to adapt and bringing a larger portion from the digital services? Now again, we were listening to the management of TCS, and they said that they are still in conversation with their clients to firstly identify new business models and perhaps then identify the more successful ones. So will it take longer for larger companies to perhaps adapt to the new environment, especially given that there has been so much dependency on the legacy business?
Yeah, in the near term, yes, the size for the large cap companies will impact the growth. And as you rightly said, earlier, say of the $100, if like $30 were going towards new technologies, this $30 is now moving to $40 or even higher. And even this incremental $10 moving to new technologies involves smaller deals. And it's not very easy to get your sales engine up and running for smaller deals, because you are competing not just with larger clients but even the smaller ones. So yes, in the near term, more so in the second half, I think that the growth for the new technologies being higher, but the legacy business seeing a downward trend should impact the large companies. But we are optimistic that select large companies should move towards higher growth from FY19 onwards, and which we believe would include HCL and TCS, to name two.
I just want to mark few stocks, Agam. Actually, it's turning out to be a day for the mid-cap IT companies. I don't know if Urmil tracks this one. Nucleus Software is up almost 14% in trade. If you could just pull up the chart of Nucleus Software. And not only that, you've got KPIT Technologies. Polaris Consulting is doing well in today's trading session. And even L&T Infotech and Emphasis. All of these stocks have seen good gains coming about in today's trade. Urmil, do you track Nucleus Software? Any specific reason why we are seeing such big moves coming about?
So the product for Nucleus Software has been doing very well, and the order book has also been very strong, but we do not have a recommendation on that stock.
All right, Urmil, we'll leave it at that. Thanks a lot for joining us and taking us through the different trends in the mid-cap IT space. But with that, we'll move on to a very important development with respect to Teamlease. Now, Teamlease has been one of the leading human resource companies in the organized space, and the company has focused on organic growth until recently. In an announcement to the exchanges a while ago, the company has stated that it will be acquiring about 40% stake in the online learning company School Guru EduServe. And to give us a broader perspective on this, joining us today is the Chief Financial Officer of Teamlease, Ravi Vishwanath. Hi, sir. Thanks for joining us. Well, I'm going to start off with your newest acquisition. Can you tell us a little more about what that can bring to Teamlease and how it can, impact business going forward?
School Guru currently works on an exclusive basis with about 18 universities, where they are the online education partner for these universities, and they currently, they have about close to between 75 and 90,000 students on record. We believe that the School Guru partnership with Teamlease will only help us improve our employability and hiring strategy with the fact that most of our candidates who we go after are fresh graduates. This will give us a pool of graduates across the country who have qualified from multiple universities, and the fact is we could also put them through our apprenticeship program and get them job ready. So we would probably have access to better quality people than what we have today. Is what we think the School Guru partnership will bring to us.
Mr. Vishwanath, it's a good day to talk to you. The stock has reacted positively to this news of acquisition. I just want to understand, how are you looking to fund this deal? I believe the enterprise value is almost 43 crore. And also from this month itself, I believe Evolve Technologies has also become the 100% subsidiary of Teamlease. Both these acquisitions put together in the second half of this financial year, what kind of impact can we see on the top line and bottom line?
The impact of School Guru would probably be very minimal for the rest of the financial year. One, it's a 40% stake, and the remaining stake would probably be acquired by us over a period of time beginning from 2019, not before that. So and the valuation is also again linked to the company's performance going forward. As far as Evolve is concerned, we should probably take, while the promoters of Evolve would be continuing to stay with us over the next 1 year, from a transition perspective, we think the process of integration itself would take about 3 months, about 3 to 6 months, and we would probably maintain the same kind of momentum as what the company has built up over the last 6 months of the current fiscal year. I don't see anything dramatic happening as far as Evolve is concerned just because Teamlease has taken the company over today. But we do hope to build on this for the next financial year. We'll probably put in place all the building blocks that are required so as to enable the company move both horizontally and vertically in the telecom staffing space from the next year onwards.
All right, sir. So I'm going to come down to the broader theme and the broader trend that we wanted to discuss with a company such as yourself. Multiple financial surveys have indicated the current hiring outlook is quite bleak. So my question then is, what factors do you think can drive end industry of workforce, and how is Teamlease specifically coping with this?
We've not seen any great hiring as far as the current quarter was concerned, because I guess the GST rollout and companies grappling with the implementation of GST at their end has probably taken more importance than the hiring itself, because so we do expect that till the GST issues get ironed out, which we expect would probably be done hopefully by the end of this quarter, we don't see any dramatic hiring to happen at our end. More importantly. But from a broader perspective, I think the government is putting in place all the infrastructure that's required from a longer-term job creation. Whether it's the structural reforms, like ease of doing business, or the GST, or digitization, or labor reforms, etc. These are longer-term structural changes that the government is putting into place, which the benefits of which will be seen over a much longer duration and not immediate short term.
Sir, today also marks 1 year anniversary of demonetization. You've mentioned GST. If I have to take both these so-called reforms, there is a shift in terms of from informal economy to formal economy. Tell us, are you witnessing that sort of change? Because if that actually happens, it will benefit a company like yours. Probably the market share which you currently have, are you looking to increase that, or the trends are already showing it?
Absolutely, we look forward to increasing our market share. You must remember that of the 129 or 130 million people who are on temp contract, we are dealing with only about 2% of them who work with formal staffing players like us. So the share of the informal sector is as high as 98%, and that's what we believe will actually is potentially an addressable market for us. We do also think that the move from informal to formal will reduce the 130 million to about 60 million over time, but the share of the formal players is actually expected to increase. Having said that, we don't think it's going to happen immediately. We do believe, this is going to take some time. We've always said that the benefit of for the staffing industry from both demonetization and GST and other reforms that are probably taking place would probably be seen over a 3 to 4 quarters, if not longer.
Okay, so Mr. Vishwanath, in an industry where you operate in, we've seen a lot of scaling coming because of inorganic growth or acquisitions. And for Teamlease, for a really, really long time, we've seen substantial organic growth. But in recent, we have seen you go ahead and acquire, companies like ASAP, Niche Pro, or Keystone for that matter. How are you going to acquire scale from here on? And of course, you've already spoken to a certain extent about School Guru, but what do these acquisitions now mean for Teamlease?
So clearly, even at the time of IPO, and we've always said that there are certain sectors where we don't have a presence, and we do think that it's probably more prudent on our part to go ahead, get an opening balance by acquiring these companies, and then build on these sectors actually. IT staffing was clearly one of the areas that we had identified as a vertical that we have no presence, but clearly wanted to establish a presence and take it up from there. That which prompted us to acquire ASAP, Niche Pro, and Keystone last year. Again, telecom was again another select vertical where we didn't have a presence because it's so. These are and we've acquired kind of Evolve, which will help us move up the value chain both horizontally and vertically within these industries. And there are many other such verticals like engineering, hospitality, healthcare, etc., which we had. These are clearly sectors where we would probably use acquisition as a method to get an opening balance and build on it thereafter.
So my last question to you, I'm sure the shareholders will be interested in this. You operate in an industry where the margins are pretty low. In the second quarter, they were just about 1.7, but the performance in the first half have been pretty good. The EPS is almost 20 rupees versus 9, which one saw in the first half of FY17. The balance sheet is looking pretty healthy. You've got cash of almost 172 crore. What next? Can you repeat this performance in the second half? And what are you planning to do with the cash which you're sitting on?
Repeating the performance depends on the markets. Like I've always said, like you've said, we do expect the third quarter also to be soft in terms of hiring. So we don't expect anything dramatic to happen in the third quarter. So it's only the fourth quarter. Probably if things are settled between now and end of Q3, can there be an uptick in the hiring itself? So that's the outlook that we have from a hiring perspective. The cash, yes, we continue to look for acquisitions. We continue to look for strategic initiatives where we could deploy them. And globally, if you were to look at it, staffing companies have grown through roll-up acquisitions of smaller players. And I guess the time is today ripe in India to start looking at those because, these would start adding value. These would be accretive from a margin perspective and enhance shareholder value. So that's what So we would probably do acquisitions or use our existing cash if it's going to add to our shareholder value dramatically going. Yeah.
All right, so and just one final question on your recent entry into IT staffing. What does that do for your margins? And if you could tell us a little more about IT.
So IT staffing, the business model of IT staffing is very different compared to the model that we have in our general staffing. IT staffing has, they have an EBITDA margin of almost about 14% is what the IT staffing EBITDA margin is 14%, as opposed to 1.7% for us in our general staffing business. The model being very different, and I think IT staffing is also at a very important crossroad where companies today see the value of working with credible staffing providers in the IT space. I'm talking about IT companies wanting to work with staffing companies in the IT space. There was a time when IT companies used to report headcount numbers, but those days are gone. I think it's today, they definitely want to work with IT staffing companies, people who are credible, who can help them scale up on time and provide them the resources when they need them. So that's where I think we can add a lot more value. We bring a lot more, we bring the scale question into play.
All right, sir, we'll leave it at that note. Thanks a lot for joining us today, and we wish you all the best for the second half of this financial year. Well, that was the management of Teamlease, but important to highlight those flashes which are there on your screen. Arvind's numbers have come, but besides that, the company has also approved the demerger in terms of the various verticals of branded apparel as well as engineering. Remember, the stock was going up in the last few sessions in anticipation of this demerger, which has come in, so which actually means they're looking to unlock the value of each and every vertical what they currently operate in. But on back of numbers, I guess the stock has seen some bit of beating coming about, and Agam, the numbers don't look that great at all. I'm just looking at the textile division. The EBIT has fallen on YOY basis. That's coming at 152 crore versus 198. In fact, there has been a sequential fall when you look at the EBIT of textile, and losses continue for the branded apparel segment, and engineering and Arvind, the internet, they do not contribute so much. But in terms of the headline number, that's the revenues as well, just a tepid growth there.
Yes, absolutely, Navneet, and I agree with you, especially when it comes to the bottom line. It's a big miss, and around 42 crores as against an expectation of 70 crores. But I think we have Yatin Mota joining us for more details. Yatin, what else are you picking up?
Agam, I was just initially looking at the release which is available. If you talk about the scheme of arrangement, apart from the earnings which have come out, we have the scheme of arrangement which has been announced by Arvind Limited. Now, basically, it's a three split, which is seen currently for Arvind Limited. One is the textile business, which will be the current listed entity. And apart from that, the scheme of arrangement proposes to split two other business segments, which is Arvind Engineering, which is basically the engineering business of the company, and one is the branded apparel business, which the market was speculating. Now, if you look at the branded apparel segment, they are expected to do a FY19 EBITDA of close to 350 crores. And if you assign a market valuation of close to 25 times EV EBITDA, and since the company is debt free, you will arrive at a valuation of only 9,000 crores for the branded apparel business. And that is what is something that the market was looking at. As far as the scheme of arrangement is concerned, I'll read it out for you. One equity share of rupees 4 each for Arvind Fashion credited for every 5 shares held in Arvind Limited, and also one share of Anveshan will be credited for every 27 shares of Arvind Limited. So basically, it's a split of Arvind Limited into three verticals. One will be the textile business, one will be the engineering business, and third, and the important one, which is almost 80% of the overall valuation, which is the Arvind brand business. So, a three-way split coming in as far as Arvind Limited is concerned.
All right, Yatin, thanks a lot for bringing all those details. So the demerger has come about. The company will be demerging into three verticals, as Yatin just highlighted. But the earnings looks like have just not been that encouraging, because the stock has seen a big beating of almost 3.5%. Also, remember, it was going up on back of that corporate action news, which has come about. So what you're seeing on your screen could also be some bit of profit booking. People who were betting on the numbers, probably they're booking their profits today. Well, that's about Arvind and Agam. It's been a year of demonetization. Looks like the bulls definitely are happy. I don't know. There are two camps. There is one camp which is definitely not happy with demonetization because the informal economy has been impacted. But look at the market returns. It's been stupendous. Nifty is up almost 21%.
Absolutely. And if you consider there are a lot more gainers in comparison to losers. And you know, if you were to take a look at some of these key movers, you would see that the momentum and the quantum of gains is also towards the gainers. But you know, that is all the time we have on this show. I wish we could you know, talk a lot more about demonetization. But it is a wrap on this edition of Trend Spotting. Up next is Hot Money.
Are we live?